Hello everybody and welcome. My name is Steven. Thank you for clicking on this video. This video, we're going to walk through the math here in Excel. I got the federal tax brackets here for 2025. We're going to show you how you can model out the difference in your tax liability from not contributing to a retirement plan and to contributing to a pre-tax retirement plan. So these plans are going to be, 403Bs, 401Ks probably more commonly. But I've had a lot of people tell me in the past that they don't really want to contribute to these plans because it's just money out of their pocket, right? It's just it reduces their paycheck, they get paid less, and they don't like that. That's actually not true. It's maybe a little bit true, I suppose, but there's actually very, very great benefits to doing this that I think people should take advantage of. So first and foremost, quite often there's employer benefits with these plans. Like if you contribute, they'll match to a certain point, or they'll just put money into it for you, and that's your money to use as long as you're vested in the program. And then what this video is going to focus on is going to be the tax side of things. So this video is not meant to be a tax lesson, although it might seem that way at times, but it's not meant to be a tax lesson. I just need to show you the math of how this actually works, and that's going to involve some of the tax brackets here. So I'm going to keep this very, very simple. Not going to layer in the standard deduction or any kind of health insurance deductions. Those are also pre-tax benefits you can take advantage of. We're simply going to just model out two scenarios. It's going to be one making $60,000 with no deductions, and one making $60,000 with deductions. We're going to show you just the change in the tax liability from one to the other. I think a lot of people that get confused about this are because they don't quite understand the tax side of it. And again, this is not meant to be a tax lesson by any means, but I think some of this might be kind of eye-opening to you as well of kind of how simple this can be calculated. It's always important to understand how much you're on the hook for taxes, right? So, I don't know about you, but I myself hate giving the government my money. I try to do anything I can to not give them my money. And of course, at the same time, trying to keep my own money, right? Because I work hard for it. I'm sure you do as well. I don't want someone taking my money. So this is one way you can do that, is you can just contribute to a employer-sponsored 401k, 403b. There's all different kinds. So that's what this video is going to be about. So we're going to walk through these step by step. And like I said, this is not a tax lesson, but it might seem that way at times. It's going to seem like that right now. So I just want to kind of explain what this is going to be before I dive into this. It might get kind of confusing for people. I want you to kind of stay with me here and keep up with what I'm doing. So in the tax brackets, the way this works is, essentially it's a marginal progressive tax. So the more you make, the more they take. But you have to understand that, like if, for example, you make, $100,000, you would fall into this 22% tax bracket. But not all 100% of that is taxed at 22%. Only the amount above and beyond 48,475 is taxed at that rate. But in this example, though, we're going to use a $60,000 taxable income as our first scenario, right? So we're going to fall in this bracket. So the key here is going to be everything above 48,475 is taxed at 22%. So the more we can get that number down, right, we can reduce our taxable income, the more we're gonna save on taxes, because this is the big jump in rate, right, from 12 to 22%. So I'm going to model this out now, again, scenario 1, scenario 2 type of thing. We're just going to start with a basic $60,000 taxable income. Again, not layering in standard deduction, not layering in any kind of health insurance deductions. We're just going to simply say we had $60,000 of taxable income and we didn't contribute to a 401k. That's the impetus for this scenario. I'm just going to simply call this scenario 1, and we'll say our taxable income is $60,000. Expand this. Okay. So again, no contribution, okay? 0. So what we're going to do here is we're actually going to calculate out the tax liability using these brackets. So we're just going to do the single filer, not going to do the married side. The math is the same, but I think just $60,000 is more of a single income, not a dual income. So tax liability. So if we're making $60,000, again, we're going to fall in this 22% bracket because we're greater than 48,475, but less than 103,350. So we're going to basically have three brackets that we got to account for. So we got 10%, 12%, and 22%. If you don't see where I'm getting that from, it's just going to be right here. The first 11,925 is at 10%. Above 11,925, but less than 48,475 is 12%, and then again above 48,475 is 22%. So we got three brackets that our money's gonna be taxed at, three different rates. So in the end, you got kind of a blended rate between the three, depending on how much falls in each. But that's again not the purpose of this video. So in order to calculate our tax liability, we got to go through each step here, do the math. So the first 11,925 is going to be taxed at 10%. So we just simply do 11,925 times 10%. So the first piece here is going to be 1,192.50. So the second piece here now is up to 48,475, but greater than 11,925. So again, our taxable income is greater than these numbers, so we still pay this entire bracket. So we'll do 48,475 minus 11,926, because that last dollar was already taxed in the first bracket, times 12%. So now it gets bigger and bigger. Right now we're at about $4,400 of our tax liability was at the 12% rate. So now finally, so we're in the third bracket now, 22%. So we got $60,000 of taxable income, so that's kind of our cap, right, our max. And now it's above and beyond 48,475, and again, that last dollar was taxed at 12%, so we're going to do 48,476. So now times 22%. So now that gives us a total tax liability of $8,000, 113 or 8,113.66. Okay. So now we're going to map out scenario 2. So it's going to be very simple. Just copy it down, call it scenario 2. And now what we're going to do is we're going to add in a 401k contribution. So, what I'm used to is about 10% roughly. I know it's all based on your budget and things like that. But I know one place I worked, the matching rate was they'll contribute 50%, but only up to 10% of your income. So meaning like if you contribute 10%, they'll match 5%. So you get 15% throughout the year in your 401k. So I'm going to kind of stick with that example, just that's what I'm familiar with. So I'm going to say we're going to contribute 10%, okay? So we'll just do times 1. So now our new taxable, this is not taxable anymore. Our new taxable is going to be our 60,000 minus our 6,000. Because remember, this is a pre-tax deduction. It comes off of our taxable income and goes into an account that we manage, right? Or well, we control, I should say. We don't necessarily manage it. But it's our money. And I'll talk more about that a little bit later. So our new taxable now is $54,000. So I mentioned that we're in this third bracket here, right? The higher bracket, the 22% bracket. But now we're going to be paying $6,000 less of income at the 22% rate by contributing to a 401k, right? And that's going to be a big difference. So unfortunately, we've already modeled this out. So all we got to do is just change this third bracket here, change the cap. So instead of having $60,000 of taxable income, now we've only got $54,000. So we'll change this. Enter. So now we got a tax liability of $6,793.66. So now we'll just kind of model out that difference so you can see. So from scenario 1, right, the 8,000, we'll subtract out scenario 2. That's a difference of 1,320. So that's going to be just very simple. It's going to be, that's money saved back in our pocket right away. As soon as we start contributing to this, over the course of the year, that's money that the government says we don't owe them. Right, so when you go to file your taxes at year end, you give them all your stuff, right, W-2s, everything else. That's the number they're going to come up with the deduction baked in. They're going to say you only owe us, $6,800 as opposed to without it you owe us over $8,000. So this is your money, right? You're going to see this right away. I kind of mentioned earlier that where people get confused about this, I think, is that they don't know how this math works. And when you change your withholding at work, you have to tell them what to take out. They don't always necessarily calculate it for you. So it's kind of on you to do this kind of math and be aware of what you owe the government at year end. Now, again, it's complicated. This is not a tax lesson. I've said this 20 times now, but it's true. But at least, again, be somewhat aware of kind of what your tax liability is, because in that way, you can adjust your paychecks to account for this, right? It's not just taking the money out; it's also taking the money out and then putting it back in through the tax savings, right? It's kind of out one side and in the other. Like I mentioned, this is all your money, right? This $6,000 here that you put into your 401k, that's all your money. Now, quite often these programs are managed by an investment company, right? They invest in blended funds that are in the stock market, whatever the case may be. So you got to go through a process to withdraw it. But the point is, though, this is still your money to do what you want with. Let's say, for example, you want to pay off some credit card debt. I've done it. You can withdraw that money and you can take it as cash and do whatever you want with. The only downfall of this, though, is that if you're, I think, less than 59 and a half your age, you got to pay a 10% early withdrawal penalty. Yeah, that sucks. But the point is, it's still your money to do what you want with, right? So like in this scenario, for example, right, you got $6,000 of your own money, not even counting any company match or any kind of stock, profit gains, anything like that. And also you've got to pay the government $1,300 less. So essentially you just pocketed, $7,320, right? $7,000 of your own money. There, guys. I hope you enjoyed that. I know it may be a little complicated at times. Hopefully not hard to follow. I tried to kind of go step by step, but I know taxes can be kind of scary for people. I know it, I personally hate them. Like I said, I hate giving the government my money. But I try to keep it as simple as possible. And I think really this calculation, when you get down to it, actually is fairly simple once you understand it. And it's important to always kind of be aware of your taxes and what you're going to owe at the end of the year, because in that way you can set your tax withholdings at your job accordingly and not overpay. Because what happens is, at year's end, the government's going to calculate this number, and then basically whatever you paid, if that's above, they're going to refund you. If it's below, they're going to bill you and tell you to pay more. So it's always important to kind of know where you're at, right? I mean, you want to be in charge of that kind of stuff and be in control. You don't want to kind of just guess and then at the end of the year, get a big tax bill or get a huge refund or something. I would much rather try to break even or get a little refund or whatever, rather than just paying a bunch of money and hope for the best type of thing. So I hope you enjoyed that. Hope you got something out of that. You watched this whole video, then thank you very much. I really appreciate it. And hope you'll come back and check out more of my videos. Thank you.